December 2, 2001. Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. $63 billion in assets gone. A year earlier, Enron had been the seventh largest company in the United States, named America's most innovative company by Fortune magazine. 6 years running. The innovation, it turned out, was in the accounting. Enron began as a fairly boring energy company. Pipelines, gas. Under CEO Jeff Skilling, it transformed into something else entirely. A trading company that bought and sold energy contracts, then bandwidth, then weather derivatives, then almost anything. To make this transformation look profitable, Enron used two techniques. The first was mark-to-market accounting. When Enron signed a long-term energy contract, it would book the entire projected profit of that contract immediately, based on its own estimates of what the contract would be worth over its whole life, not the cash received, the estimated future value. Today, this is Red Flag 1 from our free guide, link in the description. Profit recognized that bears no relationship to cash actually generated. Enron reported enormous profits, while cash generation told a completely different story. The gap between reported profit and actual cash was vast and widening. The second technique was special purpose entities. Enron created hundreds of off-balance sheet partnerships with names like LJM and Raptor and Chewco. The purpose of these entities was to hide debt and to park losses where investors couldn't see them. When an Enron investment lost money, the loss could be transferred to one of these entities. When Enron needed to borrow, the debt could be loaded into a partnership instead of appearing on Enron's own balance sheet. This is Red Flag 7. Off-balance sheet vehicles concealing the true financial position. And Red Flag 3. Debt that was far higher than the published account suggested. The man who designed many of these structures, CFO Andrew Fastow, was also personally profiting from them. The auditor was Arthur Andersen, one of the 5 largest accounting firms in the world. Andersen signed off Enron's accounts year after year. It also earned enormous consulting fees from Enron, creating a conflict between its duty to audit honestly and its desire to keep a lucrative client happy. When the investigation began, Arthur Andersen employees shredded documents. The firm was convicted of obstruction of justice. Although the conviction was later overturned, Arthur Andersen was finished. One of the great accounting firms, destroyed by one client. The collapse, when it came, was fast. In October 2001, Enron announced a $618 million quarterly loss and a $1.2 billion reduction in shareholder equity, tied to the partnerships. The questions started. The share price fell. The credit rating was cut, which triggered obligations Enron couldn't meet. The stock went from over $90 to under $1. Employees who had been encouraged to hold Enron stock in their pension plans lost everything. Thousands of jobs went. Jeff Skilling went to prison. Andrew Fastow went to prison. Founder Ken Lay was convicted, but died before sentencing. Profit with no cash behind it. Red Flag 1. Off-balance sheet entities hiding debt and losses. Red Flag 7. Debt far higher than disclosed. Red Flag 3. The guide is in the description. Free download. Enron, America's most innovative company. The innovation was fraud. Anyway,